Thank the chairman. So far, I don't think our recovery has gone too well. Matter of fact, I remain pessimistic, just as I remained pessimistic before the crisis hit, because it was easily anticipated that bubbles had formed and had to be corrected. But we've invested with fiscal and monetary policy $3.7 trillion in the last 2 years. Unemployment has gone up. There's been 8.5 million jobs lost. And if you take the $3.7 trillion that we invested to try to preserve this economy, it turns out that we've invested about $435,000 per unemployed. You know, you could have taken about 1/4 of this and given them each $100,000, and maybe the whole country they certainly would have been a lot better off. But instead, we're still thinking about tinkering on the edges and taxes and regulations and what are we going to do with monetary policy. But I have a question dealing with monetary policy for Dr. Meltzer. The 30s have been well described by many of the monetarists, explaining that there was the allowance of deflation, and that's why we stayed in the Depression too long. And those who have studied that have very much to say about policy today, and there is no shrinkage of the monetary base. I mean, it's been doubled and more than 2 times as high, and things aren't working. So what would you advise now on monetary policy? They're talking about even more quantitative easing, but is that necessarily going to do much good? Certainly we prevented the deflation of the monetary base of the 1930s, but if anybody cared about M3 anymore, which we don't record, but we do record it in the private sector, M3 was growing at 18% at the beginning of this recession. It's decreasing at the rate of 6% right now. Real M3 now is down a little bit over the last 2 years, $100 billion. So that sounds to me like deflation, according to what the monitors say. And so what do you think quantitative easing? They're even talking about buying municipal bonds, which I suspect and I predict they will, because conditions are going to get bad. Is this really going to be it, or have we exhausted all our effort with monetary policy by dealing with the monetary base?
As you well know, we have $1 trillion worth of excess reserves. People can create, banks can create all the money they want. Adding more excess reserves to that stock is not going to do anything positive for the country. As a matter of fact, the Federal Reserve does not have a serious program for getting rid of those excess reserves over time. And that's a risk that adds to the uncertainty. People like me worry about the fact that they don't know how they're going to bring that sum down. There is no central bank anywhere in the world, in a developed country, that has more than half of its balance sheet in illiquid long-term securities. None. There's never been a Federal Reserve with $1 trillion worth of excess reserves measured in real terms or any terms you want. So we don't suffer from the need for more monetary policy. We suffer from a need to reduce the uncertainty that hangs over, that is deterring businesses because they don't know what their costs are going to be in the future. They don't know what the inflation rate. The other day, I had a dinner with 2 of the shrewdest and most successful investors. I asked them, who do you think is buying government, U.S. government bonds at 2.8 to 2.9%? The answer they gave me is an answer I just don't like to believe. They said, well, basically, it came down to the greater fool theory. Well, the greater fool theory can't work for everybody. There has to be a greater fool. So they think we'll invest in 2.9% bonds now, but we'll get out of them in time. Maybe. Otherwise, we'll have some loss.
You suspect that the multiplier effect will kick in soon or never, or does it depend on fiscal policies and what we do in the Congress?
I believe it depends upon increasing. Let me say, velocity is way down. I have a chart published, comes out of my history of the Fed. It shows base velocity from 1919 annually through 2007. The current numbers are on that chart. That is, we have very low interest rates, we have very low base velocity. That's not terribly surprising. Maybe it's off a little bit, but it isn't off a great deal. So what we need is the confidence to get investment up. That's what we need. And
Gentleman's
again,
time has
at the
expired.
risk of repeating, you have to do things to give businessmen a belief that they know what their costs are going to be for the next 5 years.
I thank you.
Time has expired. I'll recognize myself.